From the financial centers of the world, this is Bloomberg Markets with Alix Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Thursday, September 15th. Here are the top market stories that we're following for you at this hour. The higher the Fed, the lower the stocks. Economists revise up the terminal rate for the Fed while investors warn of the impending stock crash. We tried to find out if 4.5% means disaster for equities, and we're still buying the stuff. Retail sales surprise to the upside as we go out and eat and buy cars. So far, no collapse in consumer spending. We're going to break it down with Craig Fuller, FreightWaves founder and CEO. And hey, old friend, Putin and Xi hold their first meeting since Russia invaded Ukraine, reiterating their support for each other, while Putin says he understands China's concerns over the war. From New York, I'm Alix Steele, my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Where do we go from here? What's going to be the main narrative, Guy? I have to say, you look at equities, zero direction, zero conviction, I think, in that rally that we saw yesterday following through to today.
Absolutely. The market still can't figure out what it wants to do here. The equity market in particular, I think, is really struggling with a narrative to hang on to. It's not clear what the narrative is at the moment. You've got people like Ray Dalio out there talking about the fact that the Fed is going to break something. You've got Goldman Sachs out saying, don't buy the dip. People are getting a little bit jittery here. The not buying the dip thing, I think, is really interesting. So I think that there is no obvious and clear narrative right now other than the Fed is going to raise rates, Alex, and at some point something is going to break. But where that point is?
And it's going to, I mean, we're looking at mortgage rates, for example. They're above 6% in the U.S. for the first time since 2008. To your point, the Fed's going to hike. Certain areas of the economy are going to slow, but we know that. I think the question is how much pain does that have to be? And is a peak in inflation really going to be good or bad for stocks? And how do you interpret that? How do you draw that through to 2023?
Absolutely. And I think the market is struggling with this. The mechanics of how this is going to work, I think, are really complicated. Ray Dalio trying to make the math work. He did this LinkedIn piece, which I know a lot of people have read. Alex, he's come out and basically said federal funds rate 4.5%, stocks lower by 20%. That's a pretty clear relationship. He also went on to say that this will bring private sector credit growth down, which will bring the private sector spending and the economy by extension down as well. So this basically takes us to our question of the day, which we're trying to figure out. We're trying to kind of answer the question which I think the market is grappling with right now. And we're going to distill it down into the kind of Dalio terms. Does 4.5% crash stocks? Now, that is incredibly simplistic. But maybe it's a starting point to try and get a handle on what is happening here. Let's start with the 4.5, then we'll talk about the market reaction. To deal with the 4.5, let's talk to our U.S. interest rate strategist, Ira Jersey. To deal with the reaction to that in equities, Bloomberg's Isabel Lee joins us as well. Ira, let me start with you. Let's start at the beginning of the sentence, the beginning of that question. 4.5%, how likely is that, and how quickly could we get there?
Well, actually, that's our target, and we think that we'll get there by March of next year. So we're only talking about another 6 months or so before we get there. Obviously, all of the things that you just talked about there, Guy, is everything that the Fed's trying to do, right? The Fed is trying to slow down credit growth. The Fed is trying to get demand for the sectors that are credit sensitive down and to slow the economy in general. Just this morning, we got some data that suggests that we are actually seeing some slowing in retail sales when you look at things like the control group. And so you are seeing at least a significant mid-cycle slowdown, if not maybe the beginnings of a more prolonged slowdown in the economy.
Okay, so Isabel, take the other side of that. If you get 4.5%, we know we want to slow the economy. What does it do for stocks?
Well, according to Dalio, a 4.5% rate increase will cause stocks to plunge 20%. So what made me think is in his post, he said it's 4.5 to 6%. So 4.5 is actually the lower end. So I was like, what will that mean for equities? And now the bond market isn't really quite cooperating with equities. A lot of people are saying the bond market has gotten it right, equities not quite. So this is what I always ask people I talk to, have we hit the bottom? And that's what Goldman's Sharon Bell has said, that, positioning isn't as bearish yet. Valuations aren't cheap enough. Multiples are still quite stretched. So it's basically my main question of the day also to the people I talk to.
Ira, 4.5 to 6. Is 4.5 the bottom end of the range?
Yeah, I think the risk is to the upside. I think 6% would be pretty astounding because, we're already starting to see some of the rollover in a lot of the real economic data that we look at. And you even look at some of the survey data might be slightly better. So you look at something like the ISM manufacturing survey and the new orders component of that has actually popped up a little bit recently. So that's positive maybe for the next 3 months. But when we look at some of the data this week, look, the Fed wants to hike. And if we get to 4.5%, again, that's our call. 5% is what Bloomberg Economics is saying. So I think that's probably the range. I think above 5% would only occur if you didn't see a significant slowing in the economy, and we're already starting to see signs that the economy is slowing. So I do think that the Fed at some point will pause. I think the bigger thing, especially for the Treasury market, and something that's being priced now a little bit when you look at what's happening with more flattening of the yield curve, is that the market has to price out the idea of early interest rate cuts. And I think that's probably the bigger issue right now for the Treasury market, and risk assets like the corporate credit market and the equity market, will have to adjust its own expectations of how you discount various securities when you have interest rates, say, for 12 months at, say, 4.5% or 5%.
Right. So I have to wonder then, Isabel, we've been talking a lot this week about how retail investors did buy the dip in certain stock ETFs. And I'm wondering if they're conditioned for those Fed cuts sooner than are actually going to happen. So what needs to then be priced in the equity market if the scenario that sort of Ira laid out comes true?
Well, that's exactly right. I think retail traders, not to oversimplify, but
Sure.
I think they're still kind of attuned to what happened the past 2 years, that if they see the stock market dip, then they buy in the hopes of it going up. But then Sharon Bell of Goldman just warned against that. She said that, this recent bear market rally might not have as much conviction just yet. And that's what I actually wrote in the column I've been helping with John Authors. We said that traders weren't prepared on the CPI report. They were probably a bit too optimistic, and it turned out hotter than expected, which is why we saw the sell-off. But on the other hand, I read a note earlier today that said, well, it's just a recalibration of expectations. It's really not anything more than that. So I think the retail traders really have to, and professional traders really have to reposition and rethink their stances on this unusual time.
Isabel, how far away from that do you think we are? You guys, I read your piece every day. It's fantastic. You talk to a lot of people. You read a lot of notes. How far away are we from that change in mindset that Sharon Bell is kind of talking about here, that ultimately the Fed will ride to the rescue? How far away are we from this idea that this is a new paradigm? The market doesn't seem to be, equity market in particular, doesn't seem to be there. It's still conditioned by the last 10 years. How far away are we from that changing?
It really depends on who you talk to. There will always be bears, there will always be bulls, but then so sometimes I get confused also, because there would be times in a day where I talk to 2 people who are bears or 2 people who are bulls, but people always have different stances. But for the most part, I think people have been telling me, at least analysts I've talked to, that there is more to go, that they haven't seen the bottom yet, and a lot are saying that we might retest the June lows.
Right, which leads us to what Ira was talking about in terms of pricing out the cuts for 2023, or at least in that first half. So Ira, last question to you. How does the Fed start to really signal that in its conference next week?
Yeah, I think that they continue to say what a number of members have said since the last meeting, and that's that once we get to the terminal rate, we're going to stay there for a long period of time. And the thing is, they haven't said yet how long that is. And I do want to mention that, look, if stocks go down 20%, I think one of the things that people are kind of used to is the Fed put. Will the Fed put come back into play when you have equity prices go down a lot? And I do think that there is still a Fed put. It's just way lower than where it is right now. And it's also contingent on inflation coming down a lot. And that's something that we basically haven't seen for 2 generations.
It is such a great point. It's there. We just don't know where it is, which is different. Ira, thanks a lot. We really appreciate it, guys. Ira Jersey, Bloomberg Intelligence. Isabel Lee of Bloomberg News, thank you very much as well. All right, coming up, it's more of the question of the day. We're going to be asking whether billionaire investor Ray Dalio is right. Will a 4.5% Fed funds rate cause stocks to plummet? We're going to talk with President and CIO of Grace Capital, Kate Faddis, joining us next. This is Bloomberg.
yes, it's true that inflation hurts people. The question is the solution that you're creating worse? And the answer is undoubtedly that's true. So it takes much longer to get rid of unemployment. Unemployment hurts the unemployed and hurts everybody. Despite what the rhetoric says, all the evidence, it's completely wrong.
Gotta love Danny Blanchflower. Dartmouth saying the Fed hikes are going to hurt the overall economy. Then he went on to say that he thinks the Fed is plain wrong. And that takes us to our question of the day. Does a 4.5% Fed funds rate crash stocks? I want to get more with Kate Faddis, Grace Capital President and CIO. Kate, do you agree with Dalio? 20% down in stocks if we get to 4.5%?
I agree with Dalio. I think, sadly, I think we're going to get that down move no matter what. But definitely 4.5% gets us there. I mean, stocks are not underpriced by any means. Stocks are still overpriced. So I think we've been in an overpriced situation for so long that we forget. The fundamentals matter, valuation matters, and it's a perfect storm.
Kate, what message are you hearing from the Fed, and what message do you think the market in aggregate is hearing from the Fed?
The Fed has been crystal clear. Their number one objective is to crush inflation. I think they couldn't be more clear. They want to crush inflation. They don't care what happens to employment. They don't care what happens to the stock market for now. They don't care what happens to the real estate market. I mean, look at what's happening in the real estate market. Pretty soon you're going to have mortgages at 8%. I mean, that's pretty extreme.
So to that point, you said yet when it came to stocks. And that was the point we were just talking about earlier, that the Fed put is there. It's just different than we're used to thinking, and it's a lot lower than we thought. What do you think the Fed put? Where do you think that is?
I'm not sure the Fed put is there. And I couldn't begin to speculate where it is. I think that the problem is things can get out of hand. The market goes down 20, 25%, people will panic. And Fed put, no Fed put. It's going to be a stampede out. We have a lot of retirees, a lot of people who rely on the market. So I think you'll get a very ugly situation.
What do I do, therefore, if that is my base case? How do I invest? Can I invest in that kind of scenario?
I think you hold cash, you hold treasuries, utilities, maybe, maybe energy. Stay away from mortgage REITs, stay away from tech, stay away from banks and financials. Investment banks are going to suffer. There's not going to be much deal flow on Wall Street. I mean, I think it's really what to avoid. Yes, if you buy short-term treasuries that reprice, you can take advantage of it. But everything else, I think, is going to be ugly. It's going to be just plain ugly.
So, Kate, you mentioned cash holdings, and we've seen overall cash holdings at the highest level since 2011, which is when we had the downgrade of the U.S. credit rating. How active are you going to be in doing that cash? I mean, it sounds like you're painting a pretty grim picture. Are you trying to wait to find a bottom or a rollover of inflation that's substantial enough?
At some point, there's going to be a contrarian play. At some point, the market will get so ugly that the contrarians are going to be willing to step in. And I might be one of the contrarians at that point. Right now, I think it's about asset preservation. I think the market is going to bottom in March. I didn't say March 2023 or March 2024, but think about it. We bottomed in March of 20, March of 09, March of 03. So beware the Ides of March.
What is you bring up a whole kind of series of cycles there. What is the nearest analog to what we're going through now? Is there an analog to what we're going through now?
There is an analog. The analog is 2000, 2001. Tech, telecom bubble, internet stock bubble. That is the analog. There was a lot of money chasing after these stocks. Valuations went crazy. They've gone even crazier. Price to sales of 20 times. It's meme stocks, NFTs, Bitcoin, cryptocurrency, things that make no fundamental sense. Not casting aspersions. No fundamental sense is all I'm saying. When is Bitcoin a buy? When is it a hold? When is it a sell? Nobody knew. The meme stocks made no sense. This is much more like the late 90s, 2000. So I think that's the closest analog.
What also feels different, though, Kate, is that there's more fiscal support coming. I mean, really from any government that you look at, whether it's in the Inflation Reduction Act, which still has a lot of money to spend on stuff. Even over in Europe, you're going to be spending billions and billions of dollars on clean energy and also capping gas bills and trying to help the consumer, et cetera. What's the conflict then between what central banks are doing and what governments are doing? Does that change the cycle that we're in?
It's going to be a very strange cycle. Remember, we've had, 2 million employees, workers just disappear. So if we have a recession, we're going to have a recession with full employment. That's pretty weird. We also have the supply shock situation with what's going on with China. And now we have jobs migrating back into the U.S. People are trying to get away from the chips, relying on the old supply chains. So there's a lot going on that is counter to what the Fed is trying to do. The Fed is trying to dampen demand, but demand is coming in from other sources.
Kate, interesting to catch up. Some interesting points you made there. Always good stuff. Thank you very much indeed. Kate Faddis of Grace Capital. Greatly appreciated. What are we going to do next? We're going to talk about the deal that looks like it's been done. U.S. rail companies and union negotiators reaching a tentative agreement after a marathon bargaining session. We're going to bring you details live from Greenville Yard in Jersey City. That's next. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Rishika Gupta. Adobe has agreed to buy software design startup Figma in a deal valued at about $20 billion. It is the biggest ever takeover of a private software company. The acquisition will help Adobe expand its tools for creative professionals. Figma allows customers to collaborate on software as they build it. Tennis star Roger Federer is retiring from the sport. He won 20 Grand Slam single titles and says that injuries and surgery the last 3 years have taken their toll. Federer is 41. He says his appearance at next week's Larbe Cup in London will be his last competitive matches. And there is a tentative deal to avert what could have been a damaging railroad strike in the U.S. The Labor Department says the railroad companies and unions representing more than 100,000 workers came to an agreement after 20 straight hours of negotiations. The government says the deal, quote, balances the needs of workers, businesses, and our nation's economy. Unions got one of their key demands as time off for some medical events. And that is your latest business flash, Alex.
All right, Ritika, thanks a lot. Appreciate it. For more on that deal, I want to go now to Greenville Yard in Jersey City with Bloomberg's Kriti Gupta's on the ground. Hey, Kriti, is this the real deal?
You know, it's interesting. When the deal started, there was a lot of questions about how the Biden administration was really tackling this, tackling it more from a wage perspective than what the railroad workers really wanted, which was more sick leave, which was time to take medical procedures, time to get those routine checks that they needed to. And that's really actually the game changer here, because as we're getting a statement from the two biggest unions in that 13 union alliance that you saw working with Marty Walsh and with the Biden administration, the biggest two actually just released a statement and said, well, actually, we got exactly that. Not only did you get one additional day off, you also got paid, for example, for that additional day off. You also get more access to those healthcare benefits and not penalized when you need to take time off for checks to go to the doctor, surgical procedures, things like that. And on top of that, the cherry on top of a pretty good Sunday for this cohort is that it doesn't cost extra. The healthcare costs aren't going to be increased. And Alex, that was one of the sticking points from the railroad sides, likes of CSX, likes of BNSF Railway, owned by Berkshire Hathaway, that they actually wanted that if those benefits were installed, that the workers themselves would have to pay those extra costs. And that is what was blocked, and I should say negotiated, by Marty Walsh and his team.
Kriti, how quickly does the network get back to normal?
Well, that's going to be the big question. That's what we're waiting for here. Remember, this is still a tentative agreement. The union membership actually has to vote on it. They have until about midnight tonight. But what's key here is that they actually have a cooling off period. Built into this tentative agreement is that if the union membership does not go through, they have about 3 weeks still where they're going to be discussing and negotiating further on some of the smaller issues, some of the fine print. And then further, the question comes back to, does Congress impose this deal on the workers, or do the workers workers actually go on strike. So that's going to be the question in a couple of weeks. But from an economic perspective, Guy, we are still waiting from the likes of CSX, the likes of Amtrak to resume operations. We heard from Amtrak earlier today that they are looking to get back to a more normal schedule after canceling their long distance train service yesterday. Of course, the Northeast Corridor, which is their busiest corridor, unimpacted by that. But that's what we're waiting for. Remember, grain shipments, intermodal cargo, those are still halted, and that's going to be the game changer for the economy.
Kriti, quickly, behind you, there's a lot of activity happening. What is happening?
Well, I'm at Greenville Yard, which is kind of a key place for that intermodal cargo I just mentioned. That's fancy talk for basically any cargo, any retail cargo that goes from a ship to a train to a truck. This is where that happens, and specifically New Jersey, which is right by one of the major ports of the entire country. What's crucial here, and what you're going to see here as we were coming up to Greenville Yard, is that a lot of the cargo that perhaps isn't getting moved, that is being halted, for example, new vehicles. We saw trucks and trucks just lined up with new vehicles on the side of the road because they're not actually able to get on the trains and move across the country. That is the most efficient way for the auto industry to move their brand new vehicles, and they aren't able to do that right now. So you did see a little bit of a buildup. Behind me, you are starting to see a little bit of activity pick up for the likes of Hyundai, for example, which you'll see named in some of the cargo boxes behind me. But right now, it still seems to be relatively quiet to what you would see on a normal day, Alex.
Great reporting, Kriti. Thanks for being out there for us and updating us. We really appreciate it. Bloomberg's Kriti Gupta. Alix, we've solved your problem. Now it'd be nice if we solved ours. Train strikes, still part of the landscape over here.
Yeah, and this is also, I should point out, just the first. I mean, if we get this sort of 14% wage hike and that winds up going through, what other public workers do you think are not going to want that? I mean, this is that's exactly what we've seen over in the UK. It's the wage ball that continues to roll.
Absolutely. And you're seeing it, as you say, rippling out across all kinds of different sectors, be it the rail strike, be it solicitors, barristers going on strike as well. It has reached the sort of the corners of this economy and continues to do so. Got a slight hiatus right now, but it's going to resume pretty soon. We're going to have more on that deal next. This is Bloomberg.
We are about an hour into the U.S. trading session. Honestly, stocks have no idea where they're going. Abigail Doolittle is tracking those moves for us. Abigail?
Yeah, well, Alex, if we take a look at the major averages, we are going to see a little bit of mixed action here. Small declines at this point. The S&P 500 now down 2 out of the last 3 days. Actually, the decline at this point is a little bit greater, down 0.4%. That NASDAQ leading the charge, down 0.5%. You can see the transport average, which had been higher earlier. This, of course, on rail stocks going higher on the announcement earlier today that strike was averted, that there was a deal made between the rail companies and the union, or a tentative deal, that it's likely. But now that seems to be fading, and crude oil really at session lows down 3.2%. Now, we had an interesting piece of data out today. Of course, earlier today we had that retail sales that was better than expected, suggesting that the consumer is still there. But the Empire Manufacturing Index, it is very interesting because it is suggesting that maybe it's not inflation we should be worrying about, but deflation. Take a look at what we have going on here, both the prices paid and the prices paid 6 months out. You can see both are declining. Now, of course, we have had a number of people recently talking about the idea that deflation could be the concern, which has really been the concern over the last, let's call it, 14 to 15 years. Not so much inflation, including Cathie Wood, Elon Musk of Tesla, and, of course, Gundlach, Jeffrey Gundlach. If we take a look at his call, it's really pretty bearish at this point. He is talking about perhaps seeing the S&P 500 drop 20%. That would match the technical charts really quite well. It would also match Mike Wilson over at Morgan Stanley, his call for a fall to 3,000 to 3,400, citing deflation as the key risk. That, of course, was the key risk back at the time of the financial crisis and one of the key risks over really, again, the last 15 years or so, and saying the Fed should stop or slow rate hikes. I think he's calling for a 25 BIP hike as opposed to the 75 BIP that is priced in for next week. As for what is happening on the day, you could see those mixed moves to some degree. So what's really weighing, not surprisingly, with oil down, the energy sector, both Valero and Devon and other big energy names lower. And here are those rail stocks, Union Pacific and Norfolk Southern, both higher at this point. Again, on that good news, Guy, that strike, at least for now, is averted on a tentative deal between the rail companies and the union. Healthcare key issue, it seems as though that has really been smoothed out to some degree.
Absolutely. Just needs to get done. needs to get finalized. Abigail, thank you very much indeed. Let's stick with the transport theme and kind of roll in the retail angle. So US retail sales unexpectedly rising in August. Consumer demand for goods looks like it's still holding up. Let's look at how the consumer is doing. Let's talk about how we are spending the extra dollars we have in our wallets. Barry Biffle is the Frontier CEO. He joins us now from the U.S. Chamber of Commerce Global Aerospace Summit that's taking place in Washington, D.C. Good morning. Thanks for joining us. Look, we've got a consumer that is still looking fairly good, Barry. We've seen a great summer for the aviation industry. Now what? What happens in the fall? Is that demand going to still be with us? Is the consumer going to stay strong?
Thanks for having us on, Guy. And yes, all indications are that the consumer's strong, and we've never seen kind of this off-season period be this strong. And we're looking forward to the holidays. It's probably going to be the merriest Christmas we've ever had from an airline perspective.
Barry, are people booking that far out right now? Because I feel like the read a couple months ago was that people were really holding tight and booking at the very last minute. Is that still the trend?
Well, not for the holidays. And in fact, if there's a flight that you want, you probably better buy it, because I think when we get a little closer, I think that the best flights are going to be sold out.
In terms of how the consumer is behaving, are they starting to trade down? You are a ultra low cost carrier. In terms of where you want to be, full service, ultra low cost, is the consumer going to be migrating towards you?
So we are seeing a little bit of the Walmart effect, right? We've seen the highest incomes we've ever seen, but it's driven by two factors, right? There is some trade down coming our way, but also we're just seeing people with a lot more money. And I think when you look at the airline industry broadly, you would expect with some recessionary concerns that you would have a demand pullback. But what you have to remember is that capacity broadly is still not back to 2019 levels, and we should be even higher. So I think you have a pretty soft landing in the airline space, because if there's any pullback, there's more than enough capacity reduction to keep the pricing, stable for the industry.
At the same time, I feel like in some ways the big carriers maybe trying to get more competitive, like the United, the Delta, the American, cutting low-cost fares there to sort of lure passengers to them. Do you feel like you have different competition this time around?
So the thing that's changed since pre-pandemic is the cost structures are actually widening when you look at debt included. So a lot of the big carriers took on so much debt, and they've got to cover that, right? And their credit rating matters when they go to roll over that debt. So that pressure is actually healthy for the broader industry. So we're seeing that in the pricing stability.
Where are you still seeing shortages? We've clearly seen an issue with pilots. Is that the only area we're still suffering from? What's happening on the ground? What's happening operationally right now that you're really struggling with?
So we've actually seen, a lot of those challenges with staffing pretty much subside. If you take the airport environment as an example, we've struggled for the last year and a half. I think the whole industry has, but we're now fully staffed, and we're now seeing it. We're seeing attrition fall way down, and we're seeing people accepting jobs. So I think there's light at the end of the tunnel if you think about it from a overall economic perspective and unemployment perspective. So I think hopefully we'll see good news with those numbers in the next few months as a result.
There was a headline yesterday that Delta is hiring, I think it's like 2,000 pilots. You guys have a pilot cadet program where basically if you don't have flying experience, you can still apply. I know you're in the middle of launching it, but what kind of conversations are you having around it? What kind of interest are you getting?
We've had huge interest. In fact, in the first month, we had around 600 applications. So we're really excited about it, and it controls the supply for us and ensures that we'll have plenty of capacity of pilots as we grow. So a lot of excitement about it, and I think as people are being forced to go back into the office, they're deciding, maybe an office at 36,000 feet is a better window view.
Absolutely. It's always a nice view out of an airplane window. Barry, let's talk a little bit about the M&A story. If Spirit JetBlue falls at the final hurdle, are you still ready to pounce?
Well, look, I mean, that's a long ways away, and we'll stay open-minded, but we'll look at that if that happens. But at this point, we've got to assume that it goes through.
If it doesn't, is it another opportunity, or are you just going to put your blinders on?
Oh, no, we're always open-minded. We'll look at any opportunity that comes up.
Are you doing that right? Does scale matter right now, Barry? Do you need to get bigger? I talked to Robin Hayes. He talks about scale. It's important right now. Do you think scale matters? Do you need to scale up in one shape or form?
Well, scale helps, right? It makes us more reliable. It makes our brand bigger. It absolutely benefits that. But we've got enough planes on order that we can continue to grow and double our size over the next 5 years. And so right now, that's our option. And we think organic is a really good place to be, because you have to think about it, too. You're in a situation where if that deal goes through, 95% of all the airline capacity in the United States will be 30% or higher costs than ours. So it's never been that good since probably Southwest Airlines in the late 80s.
Barry, before I let you go, I wonder if you could just walk me out, I don't know, a year and a half, or maybe more. You know, the airline industry is a cyclical industry, and right now everyone's trying to hire, build capacity, get everything up to snuff so we can run operationally and everything's okay. What happens if we normalize? Are we at a threat of an overcapacity situation down the line? How do you see that evolving?
No, you're not actually in an overcapacity situation, because the manufacturers, Boeing and Airbus, slowed down their production, so you actually have a significant backlog. If anything, you're going to see constrained capacity globally, as well as the United States, for the next 5 to 7 years, because they're just simply, they're trying to catch up. And then when you look at today's fuel prices, people really want the new technology. And like, for example, we're really excited to take the 321neo later this month. And when it comes in, it'll be the greenest airplane in the United States at 120 miles per gallon per seat, compared to the industry average, which is like 60. So, you just think about, they want new aircraft, but they also want the efficient airplanes, and there's only so many of them being made. So we're fortunate to have an order book and have our growth kind of controlled, because I think there's going to be constraint.
Hey, Barry, we love talking to you. Thanks a lot. We really appreciate your time today. Barry Biffle, Frontier CEO, thank you. And coming up, we're going to go from planes to trains. It's a threat of a railroad strike in the U.S. has been averted. More on that tentative deal with Craig Fuller, FreightWaves founder and CEO. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. In Uzbekistan, Russia's President Vladimir Putin told China's Xi Jinping he understands Beijing's questions and concerns about the invasion of Ukraine. It was the two leaders' first in-person talks since the war began. Xi said China is willing to work with Russia to inject stability to a world in chaos. The Biden administration today will unveil some of the planned changes for the Internal Revenue Service. They include efforts to dramatically bolster the capacity of in-person and call-in support services. Congress approved $80 billion in new funding for the tax collection agency in legislation passed last month. And a marathon bargaining session has led to a tentative agreement to avert a railroad strike in the U.S. The Labor Department says that after 20 hours of talks, railroad companies and unions representing more than 100,000 workers reached a deal. Unions got one of their key demands, that was time off for some medical events. A strike would have frozen critical infrastructure that transports about 40% of all long-haul cargo in the U.S. Biden will be speaking later next hour, and we will bring you those comments live. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alix.
Thanks so much, Ritika. So for more on the U.S. rail strike and that tentative deal, I want to bring in Craig Fuller, FreightWaves founder and CEO. FreightWaves is a market intelligence firm that specializes in supply chain data and trends. Craig, you get a frontline view to everything that's been happening. Even if we get a tentative deal, there's still like 3 weeks of uncertainty that could evolve. What are you noticing? How are companies managing it? How is this stuff getting sorted?
I think this is just one more disruption and a continuation of disruptions if you think about supply chains. I think shippers are the ones that are folks that are buying capacity on the railroads. I think largely what we've seen is that we haven't seen a lot of pressure on pricing or rates, which is suggesting that everyone is in a wait and see mode. If you sort of pull the clock back a couple of months ago, we were all worried about what would happen with the longshoremen off of the coast of California and what that meant for West Coast ports. I think shippers are just used to dealing with what would normally be called black swan events, but these events that disrupt supply chains. And I think they're just waiting and see. I think most shippers believe that even in the event that there was a strike, that the government would intervene and would force the parties back to the table and continue to operate.
How much that goes on the railway can go on the roads?
Only about half of the freight. So we think of intermodal freight, which is basically can be hauled by truck, can be hauled by train. If you look at a train and you see these containers that are stacked, that's intermodal. Only about half of the freight that goes via rail is intermodal freight, and it is fungible between trucks. So that freight is largely consumer purchases or consumer products. Retailers are not under any pressure to move that freight quickly simply because they have so much inventory. So the pressure really isn't there. The stuff that really concerns us if there were a strike would be the bulk commodities. This is energy related, oil, gasoline, chemicals, and agricultural products, the very products that have caused significant inflationary issues and have been responsible for a lot of the disruptions that we've seen just in the recent couple of months. So that's the stuff that's really concerning, particularly geopolitically. And that's something we're keeping an eye on. And frankly, if you think about what goes on rail, a lot of it's upstream commodities. So these have a significant impact on input cost. And so a disruption could really create inflationary pressure if it were to play out.
So Craig, talk me through, okay, let's just take the wages for example, get 14% wage increase. There's also some back pay. Who winds up paying for this? And does it change the way the companies are thinking about how they're transporting goods, et cetera?
I mean, the railroads mint money. It prints money.
Sure.
They're one of the most profitable forms of transportation. In fact, they're the envy of the world in terms of transportation profits. They're incredibly profitable. I think, usually when we see these union strikes or union threats on transportation infrastructure, we look at those with a little bit of suspicion. In this case, I actually think there's a valid argument that folks had to really, particularly the folks that worked in the railroads, to actually push for these items. This is a case where the unions are probably in the right to actually push for wage concessions and vacation and lifestyle concessions and benefits, because frankly, the railroads have been making so much money, are incredibly profitable. And I think rightfully so that labor deserves a seat at the table. I think this is a case where it is deserved and earned. And I think they certainly have become a victor, but the railroads have plenty of opportunity in terms of capital to pay them.
Greg, let's just talk a little bit about what you said a moment ago about the retailers and tie it in with the retail sales number that we've seen today and Alex's favorite subject, which is the lack of discounting we're seeing right now. You talk about the huge inventory build. Why are we not seeing a bigger response to it? If the retailers have got so much inventory, why aren't they discounting it?
Well, consumers are still, we've seen consumer spending still stay pretty robust. I think largely what retailers are doing is they're just trying to burn off that inventory. A lot of the items that slowed down were high dollar discretionary items. So they know that they can hold on to that inventory and they're able to sort of burn it off. We have the holidays coming up. One of the things we look at is what's actually shipping now, originating across the seas, originated in China, headed to the United States. And we've seen a significant slowdown in import activity, really started in mid-May and has played out for the last couple of months. And it just suggests that shipping demand, the amount of imported products, is going to be a lot less than what we've seen over the past 2 years, simply because retailers have a lot of inventory to burn off. So my view on it is retailers don't feel an enormous amount of pressure to burn off or to discount, because consumer demand is there and they're just not taking inventory of new product. They're just not rebuilding their shelves, and they will try to burn off a lot of this inventory as we head into the holiday season.
Yeah, some of the spending actually did hold up, but on a real adjusted basis, if you take out inflation, it's starting to roll over a bit. So maybe we're at that, getting closer to that sort of inflection point. Craig, what is still shipping a lot right now?
Well, I think, bulk commodities, as we've discussed, is still in high demand, particularly in the United States. Agricultural goods, farmers are doing incredibly well. Energy, even though we've had a slowdown in the energy markets and energy pricing, U.S. energy broadly is doing exceptionally well. So commodities are actually performing exceptionally well, which is why this rail strike could have been incredibly disruptive because there just isn't alternative modes of traffic. Consumer is certainly slowing down in the trucking market, and we think it's going to be a pretty muted peak. We don't expect a typical holiday surge that you would see going into the fourth quarter. We think it's going to be a muted peak. We don't see any indications of a surge of demand, and we certainly believe that the supply chain constraints, at least capacity related, are largely behind us, and shippers and consumers will enjoy getting their products on a more consistent and dependable basis.
What is the higher rate environment? What is the big shift we've seen higher in terms of the cost of money starting to do to this industry? This is an industry that needs to invest, Craig, in big pieces of kit. Is that still happening?
Yeah, it is an industry, as you mentioned, Guy. This is unlike a warehouse where you can sit on it and own it for 30 years. Transportation assets depreciate very quickly. Airplanes are in 20 years. Railroads have a cycle that they have to turn over every couple of years. Trucks, especially every 3 years, they have to actually turn over their equipment. And so because of that, and they're capital intensive, they have to borrow a lot of money. So that creates a lot of headwinds, particularly in trucking. The economic pressure in freight is largely trucking. The railroads, as we've mentioned, are doing exceptionally well. Airlines are doing well. Even the ship lines, even in spite of the slowdowns, are still enjoying record profits. Trucking companies are sort of in the most exposed to this, but they also have the most exposure to the consumer markets. And because you have the most exposure to the consumer markets and have high capital costs to replace equipment, any of these pressures, whether it's spot prices going down, inflation in terms of wage and labor cost, and then the cost of capital just puts an enormous amount of pressure in the market. One upside to that is that it means that the market is unlikely to expand capacity. Because it's unlikely to expand capacity, it means that the really sort of downside of the market, or a significant, we would call it bloodbath in terms of bankruptcies, we haven't seen that yet. And it may be that we largely avoid some of the really significant pressures and bankruptcies that otherwise would exist.
Craig, it's always great to catch up. Really useful insight into what is happening out there. Craig Fuller, FreightWaves founder and CEO. We're going to be hearing from the president, in theory, at the top of the hour. We'll see what the timing actually looks like. We'll bring you his comments live. This is Bloomberg.
It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. I'm Ritika Gupta. The CEO of Shell will step down at the end of the year. Ben van Beurden has been at the energy giant for almost 40 years and has been its chief executive since 2014. One of his first big moves was the $50 billion takeover of rival BG Group. That's now paying huge dividends as natural gas prices soar. Van Beurden will be replaced by Shell's head of gas and renewables. The British government may do away with a cap on banker bonuses. It's a controversial move that underlines the new government's determination to introduce major post-Brexit reforms to the City of London. The EU imposed the cap after the 2008 financial crisis. It limits bankers' bonuses to 2 times their salary. And that is your latest Business Flash. Guy?
Ritika, thank you very much indeed. Alix, this has been greeted fairly warmly, I have to say, in the City of London. One of the big concerns has always been that London can't compete post this decision with New York. It'll be good news for the UK banks. It'll be good news, in theory, for the US banks. European banks, though, will not be bound by it, will not be able to take advantage of it.
But also for spending. Like, that's not going to do anything to sort of cap a lid on consumer spending if you can raise that bonus cap. Just saying.
And it probably isn't a vote winner.
It's like a policy versus central bank kind of thing. This is a great example of how the two may not mash up.
Hugh Hendry's going to be joining us next. Haven't seen him for a while. Looking forward to catching up. That's next. This is Bloomberg.